when credit replaced trust. It didn't happen all at once. There was no announcement. Trust was simply substituted, line by line. To understand when credit replaced trust, we need to look at how banking relationships change over time. Early banking depended on personal knowledge. Reputation mattered. History mattered. Decisions were shaped by familiarity and judgment. Trust was slow to build, but hard to lose. As the system expanded, that model broke down. Scale demanded speed. Speed demanded standardization. Credit scores, risk models, and automated approvals replaced personal assessment. Decisions became faster, broader, and detached from individual stories. Today, access to money is determined less by who you are and more by how you are measured. Trust has been translated into data, risk into probabilities, relationships into scores. The system works efficiently, but impersonally. This shift solved real problems. It reduced bias rooted in familiarity. It expanded access beyond local networks. It allowed banking to grow nationally and globally. But it also removed something fragile and human. Credit does not hesitate. It does not remember context. It does not forgive nuance. When trust was replaced, discretion disappeared with it. The system became fair on paper, but colder in practice. The early signs were subtle. Decisions that once involved conversation became instant responses. Appeals disappeared. Explanations shortened. The relationship changed quietly, without resistance. And once trust was no longer required, it became optional. That change would reshape banking far more than anyone expected. As credit systems took over, behavior adjusted on both sides of the relationship. Banks relied increasingly on models that promised consistency and scale. Customers learned to manage scores instead of relationships. Financial identity became numerical. This transformation accelerated with technology. Decisions that once took days now took seconds. Approval and denial arrived without explanation. The system rewarded predictability, not understanding. Anything outside the model became invisible. For banks, this reduced uncertainty. Risk could be quantified. Portfolios could be optimized. Growth could be automated. For individuals, the experience felt different. Trust used to be mutual. Credit made it one-directional. You were evaluated, not known. Over time, this shift altered behavior. People optimized for metrics. Debt became strategic. Credit was maintained like an asset. Financial decisions were made to satisfy algorithms rather than circumstances. The system encouraged conformity over nuance. This created a new kind of fragility. When trust disappears, tolerance shrinks. A missed payment triggers penalties instantly. Context no longer matters. Systems enforce outcomes without interpretation. What once could be resolved with conversation now requires compliance. Yet the system delivered undeniable efficiency. More people gained access to credit. Decisions became faster and more consistent. But efficiency came with distance. And distance changes how responsibility is felt on both sides. The replacement of trust with credit did not remove judgment. It relocated it. From humans to models. From relationships to rules. And once that relocation happened, returning to trust became increasingly difficult. The conflict deepened when the limits of credit-based judgment became visible. Models performed well in normal conditions, but struggled during disruption. When circumstances changed suddenly, past data lost relevance. Scores lagged reality. In these moments, the absence of trust mattered. Systems could not distinguish between temporary hardship and structural risk. They reacted uniformly. Credit tightened. Access narrowed. The very tools designed to manage risk amplified stress instead. Banks face a dilemma. Deviating from models reintroduced subjectivity. Staying within them ignored human context. The system had been optimized for scale, not empathy. Efficiency had replaced discretion, and reversing that trade-off was not simple. This rigidity affected entire communities. Economic shocks translated into score declines. Score declines translated into restricted access. The feedback loop reinforced inequality. Trust once acted as a buffer. Credit removed that cushion. At the emotional peak, the question surfaced quietly. Can a system built entirely on measurement truly understand risk? Or does it confuse precision with insight? Numbers felt authoritative, but they were still interpretations of the past. During crises, institutions temporarily reintroduced flexibility, forbearance, adjustments, exceptions. These moments revealed what had been lost. Trust had not vanished. It had been sidelined, but once stability returned, the system reverted. Models resumed control. Speed reclaimed priority. The brief return of discretion faded, and with it, the reminder that trust had ever been central. Credit had not just replaced trust. It had made trust conditional, optional, and increasingly rare. The climax arrives with a quiet contradiction. The system that removed trust still relies on it to survive. When models fail, confidence becomes the last defense, and confidence cannot be automated. During moments of strain, institutions appeal to understanding. They ask for patience. They request cooperation. They rely on belief rather than data. Trust returns not as a feature, but as a necessity. The resolution is uneasy. Credit remains dominant because it scales. Trust remains secondary because it does not. The system accepts this imbalance, managing exceptions rather than restoring relationships. Efficiency wins, even when it leaves gaps. Today, American banking operates on measurement first and discretion last. Credit defines access. Trust intervenes only when systems break. What was once foundational is now conditional. This shift shapes how risk is perceived and how responsibility is assigned. When outcomes feel impersonal, frustration grows. When judgment feels automated, legitimacy thins. The system functions, but connection weakens. What replaced trust made banking faster and broader. It also made it less forgiving. And once forgiveness leaves the system, it rarely returns without pressure. What the substitution of credit for trust also changed, in ways rarely acknowledged, is the distribution of dignity within financial relationships. Trust, at its best, treats both parties as having interior lives that matter. The lender trusts that the borrower will repay because the borrower is a person with commitments, intentions, and a reputation worth protecting. The borrower trusts that the lender will be reasonable if circumstances change, because the lender also understands what it means to face an unexpected difficulty. Both parties extend some degree of interpretive generosity. Credit extends none. It is not designed to. Credit evaluates the past as a predictor of the future. It does not ask what you intended. It asks what you did. And what you did is translated into a number. And the number determines what you can access next. There is no conversation inside that process. No explanation. No recognition that the person behind the number might have a story worth hearing. For many people, this is experienced not merely as inconvenience, but as a form of erasure. The sense that the system that governs your access to resources does not see you as a full person, only as a pattern of historical behavior. That feeling is not irrational. It reflects something real about how credit-based systems actually work, and it produces a quiet kind of alienation that the efficiency gains of the model never fully account for, because efficiency gains are measured in speed and scale, not in the quality of the relationship between people and the institutions that shape their financial lives. And quality of relationship, it turns out, matters, not just for satisfaction, for resilience, for legitimacy, for the willingness of people to work with a system rather than around it. Trust built that willingness. Credit replaced it with compliance. And compliance, while functional, is a much thinner foundation than the one it displaced. Sometimes the smallest shift in perspective becomes the beginning of a new future. A thinner foundation does not mean an insufficient one. The system has functioned on compliance for decades. It will likely continue to do so. But thin foundations do not absorb shocks the way thick ones do. They transmit stress more directly. They leave less room for interpretation, adjustment, and the kind of quiet renegotiation that trust once made possible between two parties who understood they needed each other to succeed. Credit does not need the borrower to succeed. It needs the borrower to pay. Those are related but not identical. And in the gap between them lives everything the system optimized away when it chose scale over relationship. Whether that gap can be narrowed without sacrificing the efficiency that credit enabled is one of the genuinely open questions of modern financial design. not yet answered, and not yet fully asked. When credit